Hello everyone, this is Paris. Welcome to Budgetholics. Welcome to the list of the 5 best dividend stocks to buy in May. I'm sorry about the glasses problem, I should be getting a new pair within the next 5 to 10 days. First of all, with the beginning of the month, I hope all your positions are green, apart from those you're willing to build. I'm using Revolut for all my purchases, which is a digital bank, for which you can sign up using the link down in the description. If you sign up using this link, you'll most likely get a free savings account if you're a resident of the United States, UK, Australia, and some European countries. Plus, they're usually running promos, so you can suggest the bank to your friends and earn from $10 to $30 or euros, depending on which is your main currency. If you're into personal finance, investing, and wealth building, please hit the like and subscribe button. And if you're particularly interested in dividend stocks, check out my playlist, for which I'll leave a link here and down in the description. Without further ado, let's jump into the list. Number 5 on the list is Realty Income, listed on the New York Stock Exchange with ticker symbol O. Realty Income is a REIT which was also present on our April 5 best dividend stocks to buy list, as well as in some previous lists. It's a REIT with a diverse portfolio of assets, with big clients such as Walmart, Walgreens, Boots, and Home Depot. The interesting news about Realty Income is that they're merging with VEREIT. Realty Income will acquire VEREIT in an all-stock transaction, creating a combined company with an enterprise value of approximately $50 billion. VEREIT shareholders will receive about 0.7 Realty Income stocks for every VEREIT stock they own. According to a Yahoo Finance article, the two companies are expected to effectuate a taxable spin-off of substantially all of the office properties of both companies into a new self-managed publicly traded REIT called SpinCo. Following the merger and the spin-off, Realty Income will continue as the surviving public entity. So this means no more VEREIT. You'll just have stocks of Realty Income and SpinCo. So if you previously owned Realty Income or VEREIT stocks, you'll now own approximately 70% Realty Income and 30% SpinCo stocks. Again, according to Yahoo Finance, the transactions are expected to be over 10% accretive to Realty Income's AFFO per share in 1 year, adding meaningful diversification that further enables new growth avenues, strengthen cash flow durability, and provide significant financial strategies, particularly through accretive debt refinancing opportunities. Realty Income's growth strategy will still focus on high-quality single-tenant lease properties, with big clients such as Home Depot and Walgreens remaining the main clients of interest for the company. Realty Income is currently trading at $69.72 per share. They have a P ratio of 60.18 and the payout ratio of 207%, or a price to adjusted funds from operations ratio of about 75%, which could drop to 65 to 70 after the merger. They have a 5-year annualized dividend growth rate of 22.90%, and they've been growing their dividend for 27 consecutive years, making them a dividend aristocrat. The current dividend yield is 4.07%. The current Yahoo analyst's rating is that of a buy. Realty Income is trading below the average analyst's price target of $71 per share. Number 4 on the list is AbbVie, another stock which was present in our April list. AbbVie is listed in the New York Stock Exchange with ticker symbol ABBV. They produce a number of drugs such as Botox through their subsidiaries. They reported a worldwide GAAP net revenues of just above $13 billion, an increase of 51% on a reported basis. Worldwide adjusted net revenues increased by 5.2% to $12.935 billion on a comparable operational basis. They have submitted a patent to the FDA and the EMA for a drug called Skirizy. A Rinvoq study is going well, and there was a positive opinion by the EMA for the drug called Venclexta. More importantly, they're underperforming the S&P 500 in terms of P ratio, which means they're cheaper than the average S&P 500 company. They also beat investing.com's expectations of profitability and revenue. They have a P ratio of 41.15 and a payout ratio of 41.96%. Their 5-year annualized dividend growth rate is 133%, and they've been growing their dividend for 49 consecutive years. including their time as part of Abbott Laboratories, which means in just 1 year, they should be a dividend king. The current AbbVie dividend yield is 4.37%. According to Yahoo Finance, AbbVie is currently a buy as the share is trading 10% below the average analyst's price target of $122 per share. Number 3 on the list is Lowe, listed in the New York Stock Exchange with ticker symbol LOW. Lowe was also present in our January list. It's the second largest home improvement retailer in the United States after Home Depot. And if you want a comparison video about Lowe's and Home Depot, you can check out the Dividend Diplomats video, for which I'll leave a link here. During the lockdowns, they were able to build a strong e-commerce platform. And during Q3 of 2020, they reported a more than 100% increase in e-commerce sales. Given their essential duopoly with Home Depot, they're a great recovery stock. They announced that this spring they'll be hiring 50,000 people. Such an announcement not only underlines the management's confidence that the company is doing good, but also that they expect their sales to increase, hence they need more staff. Lowe is currently trading at $197.36 per share. They have a P ratio of 25.30 and the payout ratio of 24.39%. which is way below the 40 to 60% payout ratio we're usually looking at. This means that they have room to grow their dividend even more. Lowe has a 5-year annualized dividend growth rate of 120.59%, and they've been growing their dividend for 47 consecutive years. The current dividend yield is 1.16%. The current Yahoo analyst rating is that of a buy. The stock is trading below the average analyst's price target of $205 per share. At number 2 on the list, we've got Broadcom, listed in the Nasdaq with ticker symbol AVGO. Broadcom was also present in our April dividend stock list, as well as some previous lists. Broadcom designs and manufactures semiconductor solutions for a variety of connectivity applications. The company also does infrastructure software, although most of its revenue comes from the semiconductor solutions. As the recent illness pointed out, our world needs ever-increasing connectivity. Despite some flaws that Broadcom might have, it's a company that serves this need. They're innovating in 5G, wearables, connected industrials, automation, autonomous and electric vehicles, cloud and edge computing, and the current global chip shortage is definitely helping their bargaining power. This is because there is a huge demand that needs to be met, and Broadcom is one of the few companies that can serve this demand. Broadcom is currently trading at $464.55 per share. They have a P ratio of 53.11 and a payout ratio of 60.83%. This is just above the 60% upper margin we're usually setting, but given the increased demand for the company's products, it shouldn't be a problem. They have a 5-year annualized dividend growth rate of more than 700%. They've been growing their dividend for 10 years, and the current dividend yield is 2.94%. At number 1 on the list, we have Apple, listed in the Nasdaq Stock Exchange with ticker symbol AAPL. Apple was also present in the January dividend list as well as in the December list. It's simultaneously a dividend and a growth company. They make everything from iPhones to iPads to Macs, and they provide services such as Apple Music, Apple Arcade, and everything included in Apple One. There's been a report that they're developing an electric vehicle themselves, which is going to be ready in 2024. Recently, they came out with their M1 chip, available for MacBook Pros, MacBook Airs, Mac Minis, and more recently, the new iMac and the new iPad Pro. It's the largest company in terms of market cap. With a market cap of over $2 trillion. The fact that they're also a growth and a dividend stock means that you won't be taxable on your dividend income, as most of it will be a long-term capital gain. Moreover, on Friday, they were hit by an EU antitrust charge over App Store practices. The European Commission's charge is that Apple is charging Spotify and other music streaming applications a 30% fee for in-app purchases, while they're directly competing with those apps through Apple Music. This caused the price dip on Friday, which could continue on Monday and Tuesday. So it's a great time to buy the dip. Moreover, Warren Buffett said that it was a mistake to sell 10 million Apple shares. Apple is currently trading at $131.89 per share. They have a P ratio of 29.55% and a payout ratio of 17.60%. Apple has a 5-year annualized dividend growth rate of 59.11%, and they've been growing their dividend for 8 consecutive years, including the last dividend increase in the latest earnings call. The current dividend yield is 0.66%, which, if you're looking for immediate income, might not be the best choice. But if you're looking for a long-term growth stock that will also afford you some income, then Apple is the best choice for you. The current Yahoo Finance analyst rating is that of a buy. Apple is trading more than $20 below the average analyst's price target of $157 per share. This was the list of the 5 best dividend stocks to buy in May 2021. Keep in mind, I'm not a financial advisor or planner, and this video is for entertainment purposes only. When it comes to investing, keep in mind that your capital is always at risk, and always do your own research. If you need further help, seek the advice of a certified professional. I'd love to hear your thoughts about the dividend stocks you're buying in May. If you enjoyed this video, please hit the like and subscribe button, as this helps me immensely with the YouTube algorithm. Until we meet again, don't stop investing. Cheers.